ASML is a company that participated in the huge tech boom over the past few years, and over the past 5 years they are up by 161%. If we have a look at the 1-year chart, we can see that they fell from their all-time high of 1021 euros to 605 euros and are currently trading very near their 52-week low. And so today in this video I will show you exactly why investing into ASML will guarantee a great return in the near future. And to do this, we will use our stock valuation spreadsheet, where we will have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of ASML using our 4 valuation models. Now, first thing first, moving back to our stock screener, we have to plug in the ticker ASML for ASML. And right away we can see that ASML is a dividend company. They currently pay out a dividend of 0.96%, which is below average, and gives us a dividend payout of $6.56, with a trailing free cash flow payout ratio of 36.21%. And the free cash flow payout ratio is something extremely important to always look at when evaluating a dividend company, especially a dividend company that has to direct a lot of their free cash flow into innovation, such as ASML, which is in the technology sector. So with a low trailing free cash flow payout ratio, such as with ASML's, the company can still direct a lot of their free cash flow into innovation while leaving some for buying back shares off the market, paying off debt and growing their dividend. Now, before we move to the 9-pillar analysis, I just want to explain why ASML is such an indestructible company. They are the only chip machine creator with machines that can create the tiniest of nano chips, which are bought and used by companies such as Taiwanese Semiconductors, Intel or Nvidia. So they have extreme power in this specific sector, and with the AI boom, they are guaranteed to grow. But now let's jump to the 9-pillar analysis and see how the company has been doing internally. We can see that they have a rating of 7 out of 9 with 2 pillars in the red. Now the 2 pillars in the red are the 5-year PE ratio and the price to free cash flow. We can see that both of these are sitting above the ranges that we would like to see. The PE ratio sitting at almost 40 on average over the past 5 years, and the price to free cash flow sitting at 36. But if we have a closer look at pillar 1, we can see that ASML has actually been decreasing their average PE ratio by about 3.14%, but is still sitting quite higher than what we would like to see, sitting at 37.36, and we'd like it to be anywhere below 22.5, which would mean that we are paying a fair value for every dollar of the company's earnings. Now, as ASML is a one-of-its-kind company, it makes sense that it is trading at a premium, but personally I would still wait for the PE ratio to drop a little lower. Now, looking at the other 7 pillars, we can see that ASML has great revenue growth, they have great free cash flow growth, and they have great net income growth. And if we have a look a little closer, we can see that indeed the revenue has been increasing at a rate of 18.11% yearly, increasing from 11.8 billion in 2019 to 27.5 billion in 2023. That's a similar story with the net income, which has been increasing on average by 25.20% yearly over the past 5 years. And if we have a look at the free cash flow growth, we can see that on average that has been increasing by 33.85% yearly. But we can see that since 2021 it dropped from 10 billion to only 3.2 billion, and year over year it dropped by another 12.68%. So that is something we have to take into account when predicting the future growth rate for our discounted cash flow model. But now getting back to the 9-pillar analysis, where we can see that not only has ASML been growing their revenue, their free cash flow, and their net income, they also have decreasing shares outstanding, which means that they are buying back shares off of the market and increasing their institutional ownership, and with that increasing the value of the other shares outstanding. They also have a 5-year profit margin of almost 50%, which is well above the 10% we'd like to see, and they have consecutive dividend growth of 10.78%. And consecutive dividend growth is something we always love to see with every dividend company, as that is the one and only thing that can really kick in the dividend snowball effect, which will exponentially grow your dividend portfolio. But if we have a closer look at pillar 8, we can see that indeed the 5-year average dividend growth is sitting at 10.78%, but year over year they have decreased their dividends by 71.31%, which means that they cut their dividend and is one of the reasons why the company started declining in price even more. So this is something we have to take into account when predicting the future dividend growth rate for our dividend discount model. Now, before taking a look at the final and most important pillar, if you'd like to download these spreadsheets, you can always do so at the link in the description. Now, for the ninth model, we have a look at the long-term liabilities over the 5-year free cash flow negative dividends to be sitting below 5. And what this tells us is whether a company generates enough free cash flow to cover all their long-term liabilities while paying out their dividends. And so if this ratio is below 5, it means that a company won't have an issue increasing and paying their dividends into the future, and they won't get into trouble with debt. And as we can see, ASML's ratio is currently sitting at 0.2, which means that they can pay off all their long-term liabilities in about 1 year, which is awesome. Something we can see though is that they have been increasing their long-term liabilities at the rate of about 11% over the past 5 years, but this doesn't really bother me that much as their free cash flow has been growing at a rate of 33.85%, and so it outpaces the growth of their long-term liabilities. And so from our 9 pillars we can see that ASML is doing quite well. They have increasing revenue, increasing free cash flow, and increasing net income with low long-term liabilities, consecutive dividend growth, a high profit margin, and decreasing shares outstanding. The only thing I don't really like about ASML is their high PE ratio and their high price to free cash flow ratio, which tell me that the company is still slightly overvalued compared to their earnings and the free cash flow they generate. So let's figure out if we are correct and calculate the intrinsic value of the company, first using the Graham's formula revised. And to calculate the intrinsic value using this model, first we have to plug in the 5-year earnings growth estimate, which we will plug in by predicting the high earnings per share growth, the medium earnings per share growth, and the low earnings per share growth over the next few years, and average them out to get a 5-year earnings growth estimate of 23.86%. And then by taking the 5-year earnings per share, the base PE, the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield of AAA corporation bonds, and plugging all of that into the formula, we get an intrinsic value of $610.68, which is 10% lower than the current trading price. But now let's have a look at the second valuation model, the discounted cash flow model, where we take the free cash flow over the past 5 years and using the same method where we predict the high free cash flow, the medium free cash flow, and the low free cash flow, we calculate the growth rate of 18.3% into the future. And then by plugging in the discount rate at 8.4%, we calculate the present value of that future free cash flow, sum all of that up, add cash and cash equivalents, and subtract total debt to get an equity value, which we divide by the shares outstanding and get an intrinsic value of $392.27, which is indeed quite lower than the current trading price of the company. Now, normally we would compare a company to its competitors, but as ASML is one of its kind company, we don't really have any competitors we can compare ASML to, so we will skip the multiples valuation and arrive straight to the dividend discount model, where we take the dividend payouts over the past 5 years and calculate an average growth rate of 31.30%. But as we know from Pillar 8, ASML has actually cut their dividends by 71.31%, so their 5-year dividend growth is actually only 10.78%. So jumping back to the dividend discount model, I plugged in a high growth of 10.5% into the future, a medium growth of 7%, and low growth of 5%. We will average these out to get a projected growth rate of 7.5%, through which we will project the next year's dividend of $6.56. And then combining that with the discount rate, which we already plugged in our discounted cash flow model, we will arrive to an intrinsic value of $748.83, quite higher than the current trading price. And now finally moving to the ultimate valuation, we will average out the 3 valuation models and get an intrinsic value of $583.93, which is 12.75% lower than the current trading price of the company. And if we plug in a margin of safety of 10%, we get an acceptable buy price at $525.53. And so yes, even though ASML is currently near its 52-week low, it still seems to be overvalued by about 13%. So the best step to take now is to wait for the company to fall below its intrinsic value and then load up on it, as investing into ASML in the correct time will certainly bring great return. And with that, if you did enjoy the video, make sure to leave a like and subscribe, as it really helps me out.